Welcome back. Today we're taking a deep dive into the typical cycles and trends of the UK property market. By understanding the natural flow of market cycles, you can strategically position yourself to capitalize on each phase's unique opportunities. Let's explore these cycles in detail with the tools and insights that might help you maximize your investment potential. It just might be that we are now on the brim of a new phase, so don't get left out. Understanding the market cycles involves recognizing the four pivotal phases that impact property values and investment opportunities: recovery, expansion, hypersupply, and recession. Each of these phases requires a different strategy and a keen sense of timing to navigate successfully. Let's start with the recovery phase. This is the market's rebound from a low point, like after a recession or major economic disruption, like what COVID did. The phase is settled, demand begins to increase, yet prices remain the same, offering a golden window for acquisition. Utilize the UK Land Registry's comprehensive database to study historical price movements and pinpoint areas that are just beginning to heat up in terms of demand, but there hasn't been much of a price hike yet. It's easier if you have a few towns or spots in particular that you're looking at, so you can regularly check on the data that you're getting. Economic indicators. Employment rates and major corporate investments often precede the resurgence of local property markets. If you see major co-ops or shopping brands moving to these areas, use that. They have already done their research for you, so feed off of it too. Monitoring these indicators can help you identify emerging opportunities. Targeting areas that are seeing infrastructure improvements or major corporate relocations can be particularly profitable, as these often lead to increased demand for housing. Next, we have the expansion phase. Demand accelerates, supply tightens, and prices begin their ascent. Recognizing this phase early can also significantly increase your profits. What tools do you have? Platforms like Rightmove and Zoopla not only provide real-time data, but also offer insights into which areas are gaining traction. You can also use local planning insights. Keep a tab on planning applications through local council websites or some platforms like Property Data, which can reveal where future developments are set to occur, providing a clue about where to focus your investments. Buying into areas just as they are gaining popularity before they hit their peak can yield excellent returns, especially if you also focus on properties that cater to emerging market demands, such as sustainable housing or homes with space for remote work. This can also be the best time to sell or refinance, the latter being what I'd go for, because you can maximize what you get back for your investment and still keep the property if you are refinancing it. Then comes the hypersupply phase. Too many properties flood the market all at once. While this can suppress prices, it also presents an opportunity to differentiate your investments. Construction volume tracking. Use services like the Construction Index or Barber ABI to keep an eye on how many units are entering the market. You can also look at absorption rate analysis. This is where you're understanding how quickly properties are being sold or rented, which can indicate whether an area might be oversupplied. Investing in property investments or refurbs can help maintain your property's value and appeal during this phase, because it may be slightly cheaper than usual to get materials and projects done in this phase. However, it's not a time to sell. Finally, the recession phase sets in when economic downturns impact the broader market, causing property values to dip. Yet even in these times, there are strategic opportunities to persist. Financial news monitoring. Keeping up with global and local economic news via platforms like Financial Times or Bloomberg can offer critical insights into market conditions. Also look at distressed property listings. Platforms that list foreclosed or distressed properties can provide opportunities to purchase below market value properties. During a recession, holding your existing properties, if financially feasible, can be wise. Additionally, this phase often allows the acquisition of high-value properties at a discount or below market value, setting the stage for significant gains once the market rebounds. definitely the best time to buy for investors. Mastering these market cycles involves more than just buying and selling. It's about strategic timing and thorough market analysis. You just need to keep tabs really, so find platforms that can give you alerts on the trends. Some estate agents do this for free actually. Armed with the right tools and a proactive approach, you can navigate through each phase effectively, optimizing your portfolio and maximizing your profits. If you found this guide useful, please subscribe and share with your fellow investors. Happy investing!